Hey everyone, welcome to this explainer. Today we're unpacking a fascinating and honestly pretty extreme state of cognitive dissonance that's totally taking over global markets right now in mid-May 2026. Basically, we're looking at some incredibly powerful forces that are pulling the economy in two completely opposite directions.
We have to start with a truly historic milestone. 50 grand. The Dow has officially broken through the 50,000 barrier, and it's being fueled by this relentless tech-led momentum that just seems absolutely unstoppable. The Nasdaq is climbing right alongside it, and honestly, if you're just watching the ticker tape, it feels like we've entered a total technological utopia.
But contrast that absolute euphoria with this tiny little number, 1.1. Now, this isn't just any random metric. This is Goldman's Risk Appetite Indicator, or the RAI. And right now, it is flashing a bright red warning signal. To put this into perspective for you, the RAI has only been above 1.0 for 2% of the time since 1950. It is practically screaming that markets are at an extreme level of historical risk appetite. So the crucial takeaway right off the bat is that we're witnessing a massive, profound divergence. On one side, equity markets are throwing a massive party, celebrating this frictionless AI future. But on the other side, bond markets are grounded in some very hard physical realities. We're talking about the 10-year yield vaulting north of 4.5% and the 2-year crossing 4%. This sudden fixed income sell-off is catching a lot of Wall Street completely off guard.
And this tension is rippling across the entire system. Think of it like four quadrants of current market stress. Up top, you've got those record highs in equities and that sudden fixed income bond reality we just talked about. But then look over at the energy sector, intense stress. A vital energy choke point has closed, and crude has surged 9% this week alone, sitting at 104.49. And rounding it all out, a massive 28% spike in retail trading volume. It's a lot to process.
Section 1. Fueling the technological utopia.
Okay, to really wrap our heads around this dizzying market high, we need to look at the capital that's actually fueling it. $12 trillion. That is with a T. That massive number represents the capital currently just sitting in U.S. retail brokerage accounts. It's a staggering mountain of sideline cash, and it's injecting immense leverage into highly volatile sectors like AI and crypto right now.
And you might be wondering, who exactly is deploying all this capital? Well, younger investors are heavily driving the surge. Get this. 62% of investors under the age of 35 say they actively, quote, need to take big risks. That's nearly double the 33% of the general population. In fact, 43% of that under 35 cohort are actively trading options, which is just introducing a massive amount of leverage into the system.
Analysts are actually calling this phenomenon the ape factor. And with that $12 trillion acting as a catalyst, we are seeing the momentum ETF outpace the S&P 500 dramatically. The result is a Z-score greater than 3. Now, if you're not a stats nerd, that basically means we are seeing an extreme deviation from historical averages. It's being driven by short attention span money, just chasing the next shiny object using those high-leveraged options.
You can see this playing out perfectly across the sectors. It's literally a tale of two markets. On one hand, AI innovators are seeing massive premiums. Take Cerebras, they're combining compute and memory on a single chip, and they just opened with an 89% pop post-IPO. Cisco is up over 13% on AI automation. But on the other hand, legacy companies are getting hit with harsh penalties from geopolitical drag. Boeing, for instance, is down nearly 5% after heavily missing market expectations on plane orders from China. Now, alongside this retail momentum, regulators are kind of pouring gas on the fire, too. We're closely tracking the pending Clarity Act pipeline. It's already passed Senate banking and is pending a full Senate vote. If this thing clears the House and the president's desk, its immediate impact moves regulatory purview to the CFTC, the Commodity Futures Trading Commission. This could potentially unlock major institutional capital for crypto assets. The market is already pricing this in, pushing Coinbase and Bitcoin way higher.
Section 2. Geopolitics and infrastructural fragility. But here's where all that technological momentum hits a brick wall. Let's bring this back down to earth and look at the recent Beijing summit. We have two superpowers with completely competing objectives. On one side, U.S. leadership was prioritizing market access and reciprocal trade. On the flip side, Chinese leadership was hyper-focused on strategic stability and ensuring its own uninterrupted economic and geopolitical rise. The scorecard from that summit shows exactly why the market's current utopia is pretty fragile. Sure, there were points of agreement. Both sides agreed Iran cannot have a nuclear weapon, and there's a shared intent to keep the Strait of Hormuz open. But the friction points? They are intense. We're talking severe, unresolved clashes over overall technology dominance, U.S. access to rare earth metals, and some incredibly sharp warnings over the handling of Taiwan. And that last point brutally highlights why friction over Taiwan matters to every single investor right now. This one geopolitical flashpoint underpins roughly half of the S&P 500's total market value. TSMC sits at the absolute center of this bullseye, manufacturing 90% of the world's most advanced chips. The cascading rings of dependency flow straight out from them to Apple, NVIDIA, Microsoft, and really the entire AI supply chain. That cascading risk translates to a staggering number, $30 trillion. That is the global market exposure resting entirely on TSMC and its highly vulnerable supply chain. $30 trillion teetering on a geopolitical knife edge, which the broader market is honestly just pretending doesn't exist right now.
Section 3. Infrastructure, innovations, and arbitrage.
So, knowing all these massive real-world bottlenecks are out there, where's the smart money looking for opportunities? One huge area is what's known as climate arbitrage. The disparity here is wild. Traditionally, if you needed to remove phosphorus and nitrogen to meet regulatory pressures, it required a massive $400 million conventional facility upgrade. But new innovations like the Crew carbon process can solve that exact same problem with a $2 million installation. It injects limestone, bonds with CO2, increases water alkalinity, and supercharges microorganisms to do the heavy lifting. That is a $398 million savings gap that also captures carbon. Another massive bottleneck? Energy. And here, we are seeing the administration actually step in, deploying $94 million in 50% cost-sharing grants, specifically targeted at small modular reactors, or SMRs. You can see this building out all across the country. Government funding is flowing into New York to target a gigawatt of new capacity, into Indiana for containment vessels, and North Carolina for fuel rods. Why is this such a strategic imperative? Because the AI boom demands absolutely massive continuous power. But private companies are flat out refusing to shoulder the sheer financial risk of nuclear construction alone. The government is basically forcing a fast-track nuclear renaissance because AI literally cannot run without it.
Section 4. The ultimate market collision.
Okay, this brings us to the ultimate collision course these markets are on right now. Let's circle back to Goldman's risk appetite indicator flashing red at 1.1. Historically, when we see conditions like this in RAI over 0.9, coupled with crazy high momentum, we are closely mirroring the turn of the millennium. Out of 8 similar episodes since 1962, 3 resulted in a bear market within 2 years. Now, the caveat, of course, is that in 1999 and 2021, equity prices peaked nearly 12 months after the signal first triggered, so timing is tricky. But this perfectly illustrates the core macro takeaway of our entire explainer today, the divergence. On one hand, the market is completely pricing in a technological utopia. We've got $12 trillion in retail capital, massive IPOs, a 50K Dow. It's assuming AI productivity will just magically outweigh all Earth-3 friction. But on the other hand, it is entirely ignoring our infrastructural fragility. 4.5% yields, a $30 trillion supply chain sitting on a geopolitical fault line, and crude oil spiking because of closed choke points. We are quite literally operating in a state of unprecedented cognitive dissonance. So the defining question I want you to take away from this is, can relentless technological momentum permanently outrun the physics of the global bond market and the harsh reality of geopolitical rivalries? Put simply, can the code outrun the concrete? It is the multi-trillion-dollar question for the months ahead. Thanks for joining me on this explainer. Keep learning, keep questioning, and I'll catch you next time.